After I did my last video talking about the stocks that I believe will outperform in 2025, I got a lot of questions about a lot of retailers because I did say I believe retailers will do very well in 2025. One of those stocks was EL, which is Estee Lauder, and I talked about it many times before, and a lot of you know, I was bearish on it many times in my videos, but now it's sitting at $88. And this is another one of those quality stocks, amazing companies. I think even Terry Smith used to own it. Maybe he sold it. I'm not sure if he still owns it. But this was well known as a quality company. It have many amazing brands, but it's down 54% over the last 5 years. And just look at this chart. I mean, I don't know how the stock went to 354. I don't know what the market was thinking. And you still have some people believing the market is rational. I don't know how. But from 354 to $88 per share. But it's not the only one. You have stocks like L'Oreal. It's been struggling this year, down 16%. EL down 41% year to date. You have stocks like LVMH down 14%. And a lot of the fashion stocks, retailers, many of them, it hasn't been a good year. But I believe 2025 will likely be much better for a lot of them. And a lot of you are familiar with EL. They own many popular brands like the MAC makeup for women and people that use them, and so many different brands. I think Tom Ford, they also own Tom Ford, and a lot of different kind of brands that they own. And Estee Lauder brand is pretty popular stuff. And the last earnings report wasn't the best. Organic sales still decreased 2%. Adjusted EPS declined 25%. I mean, it's been a disaster for the company. They did say that the company has returned to growth in terms of net sales in the second half, but it's been an absolute disaster. And you could see it with many different metrics. First one is net income margin. Their net income margin went from 12% to 5%. And it's really, really bad. You look at the inventories, which is the reason why. I think there's two reasons why. You look at the chart of Estee Lauder and you see the stock rising to 360 and falling to $88. There's two main reasons. The first one, which is the company making the same mistakes that Nike has made, the same mistakes that a lot of other brands and a lot of retailers have made. And this mistake was thinking or believing that the 2021 popped up demand caused by stimulus checks was sustainable forever. This is what a lot of those companies did. There was pump up demand in 2020, 2021. They started stocking up on inventories, increasing capacity, making more stuff because they thought it was sustainable, but it wasn't. It was mainly a lot of stimulus checks and a lot of people being locked down, and they save some money. They spend that money, the money is gone, and inventory skyrocketed for companies like Nike and even for companies like Estee Lauder, and they had to sell a lot of them at lower prices, do some discounts, try to get rid of them for them to be able to get rid of the inventories, which they successfully did. And now their inventories are back just where they were in the beginning of this mania in 2021. So they did a lot of improvements, but their net income margin, you see, it has suffered because they had to take price cuts on certain items and they did a lot of things. And this is a mistake that a lot of those retailers make. And this is the first reason why a lot of those stocks are down so much year to date and over the last year or two, actually. And the second one is mainly from the weakness in China, because such companies like Estee Lauder, for example, 33% of their revenues is from Asia Pacific, and China likely makes up a large percentage of this 33%. And China has been extremely weak. You look at the consumer confidence. Consumer confidence is extremely low on a historical basis. If they're even having deflation, and this is a report by Bloomberg, it says China's economy-wide prices in longest decline since 1999. They've been declining every single quarter. You don't have that happen very often. And you should look at used car prices. Everything is declining. Even property prices are crashing. So China is in a very bad situation. The Chinese consumer isn't as strong as they were. And they spend a lot of money on those brands. A lot of money on brands like LVMH, Estee Lauder, and these kind of brands. Gucci, which is also suffering. L'Oreal is also going down. And a lot of those companies, they've been suffering. And some of it has to do with China. And as China eventually recovers and it gets better, and it looks like it's going to take a while, these stocks will likely keep suffering. And with you both having China and the United States starting to slow down, I mean, it's not going to be a good mix for those stocks. But if you look at where EL is trading at, even after the stock is down, 42% over the last year, you look at where EL is trading at, is trading at 29 times free cash flow. I mean, I just couldn't believe it. 29 times free cash flow. The stock went up as high as 63 times free cash flow. It's not like it's a tech company or anything. 63 times free cash flow. Now it's trading at 29 times free cash flow, which is, in my opinion, is on historical average. But in my opinion, it's still extremely expensive for the company, especially now. This is not 2017 anymore. You have a lot of competition from many different brands, even some cheaper brands coming out of China, coming out of different places. There's so many alternatives, so many competitors. And I think a lot of the brands that a lot of those companies own, in my opinion, they're not as strong as they used to be. In my opinion, a lot of them are using their edge. And that's my opinion on a lot of the brands that Estee Lauder actually has. But if you look at the free cash flow, to be fair, it's expected to massively grow. I mean, from $1 billion in fiscal year of 2025 to 2.1 or $2.2 billion. So it's expected to more than double over the next 5 years, which could warrant a 30 time free cash flow multiple. Although I still believe it's extremely high, and no one really knows how long the recovery is going to take, because I saw such estimates like a year or two ago, and EL had to take out all the inventory, and it wasn't a good picture, and the analysts were wrong. But assuming the analysts are right, and they do get to, let's say, $2.2 billion, and we use the current multiple, which is around 30 times free cash flow, and if we time it by 30 times, which is the mean multiple also, and I believe it's expensive, by time it by 30 times, this is a $66 billion market cap. The current market cap is $30 billion. So you're getting pretty much 120% on the upside over the next 5 years if you're buying EL today. But this is if the company trades at 30 times free cash flow, which I'm not willing to bet on. And this is if the company was able to double the free cash flow over the next 5 years, which is not going to be easy to do, especially if US and China, they don't recover as fast as expected. It could take longer than 5 years for them to double the free cash flow. So for me, looking at EL over here, I think there's a lot of bad stuff that's priced in, and the company never really got cheap. I mean, I would wish it could trade at 15, 20 times free cash flow, and it traded there sometimes. But it really never gets there because it's perceived as this quality company, and there's always a bid on it and people want to own it. And it's just why it used to trade at 30, 31 time free cash flow. But I believe it's expensive. But for me personally, EL is not a buy. It's not because the stock can go up. It's not because, it cannot play out and go up 100 or 120%. But I compare EL to something like LVMH, which I personally believe LVMH has much stronger brands than EL. And if you compare the two, EL is trading at 30 times earnings and LVMH is trading at 19 times. For me personally, I would much rather bet on LVMH. Even though EL is expected to grow faster than LVMH, LVMH is expected to grow EPS like 8 to 10%, sometimes 11%. EL is expected to grow up to 20%. So it's expected to grow much faster. But if I had to make the bet, I would bet on LVMH rather than EL, because I believe LVMH has a little bit of a stronger brands, and they're more diversified. And I like it very much. So if I had to choose, I would choose LVMH over EL. For me, EL is still not appealing enough with any kind of margin of safety for me to take a position. But if I had to bet on one of them, it would be LVMH. Again, nothing against EL shareholders, but I'm just sharing my honest opinion on the stock. Sometimes I tell you stocks are a buy if I think they're a buy. Sometimes I tell you they're not a buy if I believe they're not a buy. I'm not here to try, just to get views and for everyone to agree with me. I'm just trying to say the truth. And for me personally, I don't think EL is a buy. I would much rather buy LVMH, which I did own before, and I might buy it again. And this is just my opinion, not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.